When you think about the future of finance, you probably picture Wall Street, maybe Silicon Valley. But you know, some of the most groundbreaking financial innovation on the planet is happening somewhere else entirely. So let's dive into the incredible story of how Sub-Saharan Africa is leapfrogging traditional banking and literally building a new digital money ecosystem from the ground up. It's this amazing revolution born out of necessity, and honestly, it might just be showing the rest of the world the way forward.
To really get what's going on here, we have to start with a single number, 9%. See, for millions and millions of families across Sub-Saharan Africa, money sent home from relatives working abroad, we call that remittances, it's an absolute lifeline. But sending that money home is just ridiculously expensive. On average, to send a $500 payment, it costs a staggering 9% in fees.
And just to put that number in perspective for you, the United Nations' big goal is to get those remittance costs down to just 3%. So at 3 times that target, Sub-Saharan Africa has some of the highest costs in the entire world. And this isn't just some abstract fee. It's like a massive tax on a really critical source of income. It's the perfect setup for a totally radical new solution.
So, you gotta ask, right? Why were these costs so incredibly high? Well, it all goes back to the pretty unique financial landscape you find across so much of the continent. Let's take a look.
Okay, here's the first huge piece of the puzzle. In advanced economies, pretty much everyone, like 97% of people, has a traditional bank account. But in Sub-Saharan Africa, that number is just 33%. Think about that for a second. 2 out of every 3 adults are basically locked out of the formal banking system. That created this massive void.
But here's the twist. While bank accounts were super rare, something else was becoming totally universal: the mobile phone. With about 80 subscriptions for every 100 people, the cell phone, well, that became the key. The key that could unlock a completely different financial path, one that didn't need a single bank branch or ATM.
And that was the opening. This is exactly where private companies, especially the big telecom operators, saw this huge gap in the market, and they jumped right in. They didn't even try to copy the old system, they built a completely new one. And in doing so, they kicked off the mobile money revolution.
The most famous example, of course, is M-Pesa in Kenya. It launched way back in 2007, and it let people send and receive money with just a simple text message. I mean, the impact was absolutely profound. This quote here shows it wasn't just a convenience. This was a powerful tool that was literally lifting people out of poverty, especially for women-led households, who all of a sudden had new ways to build businesses and financial security.
And the adoption? It was just explosive. Just look at this timeline. In less than 10 years, the average number of mobile money transactions per adult grew 6 times over. This wasn't some slow, gradual shift. This was a complete and total rewiring of personal finance for hundreds of millions of people.
And by 2021, get this, mobile money wasn't some little niche service anymore. The total value of all these transactions hit 45% of the entire region's GDP. So the point here is that this innovation, which started in the private sector, had become a core pillar of the economy.
Now, of course, this kind of massive success, it did not go unnoticed. Central banks and governments started looking at this, and they saw both the incredible opportunities and, the potential risks of having this huge parallel financial system run entirely by private companies. So, naturally, they started thinking about what their role should be in this new digital world.
And that brings up a really important question for us to think about. If private mobile money was already working so well, solving so many problems, why on earth did central banks feel the need to step in?
Well, their answer is something called a central bank digital currency, or CBDC. The easiest way to think about it is like official government-issued digital cash. So instead of being issued by a private company, like a telecom, it's a direct digital version of the national currency, backed by the full faith and credit of the central bank itself. This slide really breaks down the difference perfectly. On one side, you've got private mobile money. It's created by a company, its goal is profit, and your balance is basically an IOU from that company. But on the other side, you have a public CBDC. It's designed as a public good for financial stability, and your digital cash is a direct liability of the central bank, which makes it, by definition, the safest form of digital money you can hold.
So why do it? Well, countries like Nigeria, which launched its eNaira, and Ghana, which is piloting the eCedi, they're exploring these CBDCs to push those transaction costs even lower, to make sure their payment systems are rock solid, and, really importantly, to spark more competition by creating a public platform that all the other payment providers can build new things on top of.
But wait, there's a third major player in this story.
one that's disruptive, decentralized, and for the most part, totally unregulated. And that, of course, is the wild card, the world of crypto assets.
This slide really captures the two faces of crypto in Africa. On the one hand, yeah, it offers a potential way to protect against high inflation and a way to make cross-border payments even cheaper and faster. But on the other hand, the risks are just huge. Insane price volatility, major worries about financial crime, and just really critical danger of something called crypto dollarization. That's when a foreign crypto asset, like a stablecoin, effectively replaces the local currency. And that is an absolute nightmare scenario for a central bank, because they lose control over their own economy.
So given those massive risks, the IMF report that we're drawing on here is crystal clear in its recommendations for policymakers. And the number one point is totally unambiguous. Do not, under any circumstances, adopt crypto assets as an official currency. Instead, the advice is to build strong regulations, to protect consumers, and to keep a very, very close eye on the very real risks to financial stability.
Okay, so we've got these three powerful forces all at play: private mobile money, public CBDCs, and decentralized crypto. The big challenge now for policymakers is how to weave all of these threads together into a single system that is innovative, inclusive, and most importantly, stable.
The report lays out this really balanced four-part strategy. First, hey, don't stifle what's already working. Support private innovation with smart, pro-competition rules. Second, build the public digital highways, things like fast payment systems that everyone can use to level the playing field. Third, you've got to regulate the new frontiers of crypto and CBDCs to manage those risks we talked about. And finally, work together across borders to make the entire system seamless.
And this brings us to what might be the final, most crucial point of all. All of this amazing financial technology is only as strong as the economy it's built on. In other words, you can have the best, slickest digital tools in the entire world, but they won't reach their full potential without sound economic policies that build trust and stability in the currency itself.
Which leaves us with this one last, really fascinating question to chew on. For decades, the flow of financial innovation has pretty much been one way, from north to south. But by solving its own unique problems, is Sub-Saharan Africa now pioneering a brand new model for digital finance, one that's more inclusive, more resilient, and that could, just maybe, end up becoming the future of money for all of us? It's definitely something to think about.